Welcome to the Treasury Update Podcast, coffee break sessions presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. Welcome to another great episode of the Coffee Break Sessions. I'm your host, Jason Campbell, and joining me today is our managing partner and founder of Strategic Treasurer, Craig Jeffery. Craig, welcome to the show.
It's good to be here, Jason. I'm glad that you know it's a great show before we start.
Of course it is. It's coming up on my almost my year of doing the Coffee Break Sessions. So, and I don't think I've had a bad one yet that I know of. So I'm going to go with every show is going to be great from here on out. Okay. Yeah, that's just the way I'm going to do it. But today on this session here, we're going to talk about an interesting topic. You and I have kind of had some dialogue and conversations around this previously and felt it would be a good topic to talk to our listeners about here is a little bit about counterparty risk. And I know in some of the webinars we've hosted and polling questions or what some topics folks would want to hear from us. And this come up actually quite a few times. So I'm kind of intrigued to really hear your subject matter expertise in this. So let's kick it off and talk about, Craig, our listeners, let's walk through what is counterparty risk.
So counterparty risk is some type of exposure to some type of unfortunate, unexpected, or unhoped for event. Counterparty is the other side of a transaction or who you have some exposure to. So counterparty risk is oftentimes thought of if you have some kind of bond offering or settlement that's occurring, the other party fails to complete their transaction. Counterparty risk is broader than that as well. It's any of those types of exposure. So it could be balances that you have in bank accounts. It could be you have a line of credit, and what if the bank cannot fund that? Or you have a payment coming due. You have some kind of investments, and then the paying party doesn't pay you. There's a range of these items that fall into the category of counterparty risk. More recently, what's been in the news is concerns about banks, and if you have uninsured deposits, they're not covered by FDIC or some other insuring agency. If the bank fails, anything above the insured limit is potentially at risk, and at risk for not getting paid or at risk for getting a portion of those funds over a long period of time, and so being tied up with that. So it's the risk you face from counterparties. Now there's vendors are counterparties, customers are counterparties. Vendors, it might be they can't provide you goods or materials, not necessarily that they're providing you money. Customers, they don't pay you, they delay paying you for some period of time. And then certainly financial firms is what we spoke about.
So I guess from a standpoint of looking at it from the angle is counterparty can be considered like that, like you said, the other side of that transaction, and just, knowing that everything hopefully goes smooth, but also trying to put in your planning is the what ifs, right? The contingencies, and just keeping an eye on and ensuring that wherever the funds are lying on the other side is in a safe place, and that the measures have been put into play to ensure that protection is key, right? So why does this matter?
Well, it matters because the loss of funds or not being able to complete transactions. You have you put an investment out there, you're expecting safety of principal and some type of reasonable yield for your return, and then you don't get those funds back. And so concerns over the U.S. not paying interest when it comes due was a recent discussion, but also corporate bondholders, are we going to get our payments? Those are types of concerns. But to the point earlier, well, it matters too on the bank side. If you have significant operating flows through a bank account, the bank becomes insolvent and you have 20 million, 50 million, whatever the number is above the insured limit, you have a real exposure to that type of loss. You also have an exposure to the operational concerns. How do you keep paying, receiving funds on a regular basis? So this matters greatly. It's about operational risk and financial risk kind of tied up together when we think about bank accounts on the counterparty risk front.
Going back, I was thinking, talk about a bad day, right? Bad day being like, I couldn't even fathom, having like 30, 40, $50 million or whatever, just money in general locked into a bank that if the bank is all of a sudden goes insolvent, I can't get to that money, right? Well, that's a bad day. I don't know about anybody else, but I think that's a pretty good one that would probably warrant a definitely outside scream for sure.
Well, and it was. And when we're looking at Thursday for Silicon Valley Bank, that Thursday when $42 billion was moved out of that bank to other banks like very quickly. And then there was this freezing of the activity. Like people couldn't move funds. There was too much traffic happening. And then over the weekend, people were like, how am I going to make payroll? What am I going to do? Because my funds are there. I can't access them, or it's above the limits. There's a lot of hyper concerns there for good reason. So yeah, that can be a very, very bad day.
Yeah, I would say so. So some advice though on your end here, how do companies manage this?
How do they, or how should they?
Could be both. Could be a 2-point question. So I think you could probably hit on both sides.
So how do they is a lot of, we think about how you manage risk. It's usually accept the risk, alter the risk, or avoid the risk. And you can alter the risk by changing how you do business. It could be altering it with financial instruments. And that can be the case. There's also ignore, and far too often companies and people ignore the risks that exist. Oh, that's so unlikely to happen. We're not going to look at it. And so when you say, how do companies manage this? Well, many don't do much in the way of counterparty risk management across the board. They look and our banks are fine. They're going to be covered. They're not doing any regular monitoring. They don't necessarily go through a thoughtful, organized process of what are our exposures, identifying those, finding some way to calibrate those. What's the risk level? What's our tolerance for, some type of loss? You're not going to split up all of your operating activity to 500 banks and keep your limits under 250,000. But how do you identify the risk level? And then how do you move some of that risk off? In the case of balances at banks, what's the level that's above what's insured? And what are you comfortable with bearing? And then what are you not? So exposure identification, what are our exposures to what counterparties? How hard is it to move? And do we have a plan and an ability to move those quickly? Like so many people who are frantically wiring $42 billion out of the bank we were talking about. This calibration of saying, what do I have that's not covered? It's one thing to say I have 5 million here. 250,000 is covered by FDIC insurance, so I've got a backstop. What about the other 4.75 million? Am I just exposed for a short time and I can get out the next day? So if I start to get a whiff of a trouble, I can move and diversify. Do I put that into particular investments where I hold the securities as opposed to I'm exposed to the bank, so I'm only exposed to the securities? Maybe they're government issued, debt, T-bills, what have you. Those are some ways that people help adjust that, calibrate the risk. What am I doing? What is my net overall exposure? And so when we think about exposure to counterparties and operational exposure, most people nowadays are thinking of I need multiple banks. So when you think about what are companies doing with actually managing the counterparty risk, it's not formal in many cases, like I said earlier. It's less than half of companies have a formal, detailed plan for managing their counterparties. On the financial side, they're like, oh, we've got it in a big bank. It's extremely informal. We have our funds here, there, or it's not a big enough risk to do anything about it. They haven't gone through the process and said, here is where we're exposed. Here are the limits. Here's what we're comfortable bearing versus altering through operational changes or altering through financial instruments. More than half aren't doing that. And that's the problem. Everyone should be a little more formal in that. That should have been done and been consistent, certainly after the 2008, 2009 financial crisis. But when those issues started happening with banks, it became more apparent. The central banks were raising rates very rapidly. That created significant challenges for a number of banks, not really being willing to look at counterparty risk only in the panic of the moment is not a particularly good strategy. So they should be what were our exposures, what are the level of exposures that we're willing to take, what do we need to do with the others, how do we do that? So ignore, accept, alter, and avoid. Too many are doing ignore. Accepting risk can be just fine. Does that fall into our capacity? Altering those risks, like, okay, I have multiple banks. I move my investments above a certain amount into some other type of investment vehicle, so I'm not exposed to a particular financial institution, or I avoid it. I avoid certain types of scenarios where I say this creates too much of a risk environment. Some people buy credit default swaps, or they'll monitor things, not only what the risk level is from a historical perspective, but they'll use things like the DuPont model or other methods of looking at what the exposure is to bank or capturing other data points.
So the biggest thing is I think a good key takeaway in this episode would be to, when's the last time you've done that health check? And obviously you don't want to ignore as things do happen, as we can see. And when we think everything is fine is typically when, unfortunately, bad events sometimes occur. So, and for our listeners, if there's situations where potentially you're not sure what direction you may need to take, there's services, there's companies out there like Strategic Treasure that you can lean on for more advice or, more direction on that piece of it. Craig, thank you so much for joining us today. We greatly appreciate it. And to our listeners, please remember to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. And if you've got any questions, comments, want to drop us a note, please send us an email at podcast@strategictreasure.com. And until next time, take care.
Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.